Debra. You're with the Property Frontline podcast, and today I'm speaking with Ken from Avvora. Hello, Ken.
Hi, Deb.
Our main topic today is about refinancing. It's one of the key ways that you can really maximise your position while you're preparing to take your next steps in the property market. So, Ken, what are the first steps with refinancing?
Yeah, sure. I guess the first step would be to kind of work out what your financial position is. So as a finance broker, I'd walk you through and work out what your financial position is, which includes income, expenses, assets and liabilities. And also some of the things that are probably important to take into consideration is if you've got access to guarantors, where your equity is coming to make that purchase, or if it's a refinance. It's probably not too much of an issue, but yeah, it's just to kind of work out, and what your borrowing capacity is would probably be the main thing.
So can we talk about people who might already have a property and are looking at maybe going from their first home to their forever home?
Okay.
Or going from their big house and wanting to buy a smaller house plus a couple of others.
Yeah.
So those two scenarios.
Okay. I guess one would be to work out where you're getting how much equity is available, because with any purchase, I guess there's two items. One is the borrowing capacity, so can you actually make the repayments, and what the absolute maximum loan amount is that you can work, and those are your boundaries. And then the next would be, I used to say it's equity, how much money you're putting into it, but if you've got property, it's basically LVR. LVR seems to be the item that limits you. So if you're trying to borrow 100% based on the properties that you're using as security to support the loan application, it won't work. Basically, the bank wants to make sure that in the unfortunate instance where you're unable to make those repayments, it's more of a risk management thing. If they sell the property, can you extinguish the loan?
Yeah.
Pay it out, have nothing, square out the debt, anything left over you can keep. So those are probably the first step, which would be to work out how much equity you've got access to. Questions like whether you want to cross-collateralize the properties, if it's an option, how fast you're wanting to move. And the next one would be whether you can actually afford the additional debt. So sometimes there's a little bit of playing around from what I can tell. Like there have been some clients who require to take cash out for the purchase, or sometimes they want it just as a approval in principle. It depends, right? If you're going for, if you're doing the refinance and the purchase with the same lender, you can do things. If you want to do the refinance as a first stage, clear that out, have the funds ready in your offset account, bank account, wherever it might be, to then go to a different lender to make the purchase. It depends on the strength of your application, the credit policy that each lender is offering. You might require to go with just the one lender, or split between the two.
And so would my first step be to come and speak to someone like you, or should I be doing some preparation myself before I
think it's a bit of a chicken and egg scenario. So I think it'd be good to do a very quick preliminary check to see what you're wanting to purchase, because some of the questions that we would ask, or the numbers that would come into play when speaking with a finance broker, is what the property, how much you're purchasing the property, because that will affect the LVR, or loan to value ratio. So if you're buying a small amount, $300,000 property versus an 800, it's going to affect what your LVR is going to be, because usually your equity and your savings are going to be a fixed amount. So having an idea on what you're wanting to purchase, also then if it's for investment purposes, how much rental income you're expecting. You probably don't need to have a concrete idea. Ranges are probably good. In this case, it's like, I want to buy a small, 2-bedroom townhouse, 600 to 800, or give ballpark figures, and it'll rent for X, Y, Z. That probably helps in a planning session. So then, we'd workshop everything out. So it's good to.
So if I was moving from my first home to my forever home, how would that work with you? Would I come to you with a bit of an idea of what I wanted to buy, and then you would work out
how much there was available, how much equity would be available, because how would that sequencing work?
Yeah.
Would you ideally in this market we want people to sell first, then buy, or do it at the same time?
Yep. It would. I mean, that's where the benefit, I guess, of speaking with a broker who can kind of workshop that scenario out. Because I think, sometimes, do we do the bridging finance, sell and purchase, because you already have the property locked up and you're confident that you can sell. Maybe you want to break it down into 2 stages: sell first, get the equity in your bank, and then make the purchase. Can you negotiate if you do find a property that you like, can you negotiate terms? Like, could you extend the settlement out? And there's a whole bunch of things, I guess. But from, I guess, the conversation with broker would be to just work out what is possible and what isn't, and then you can start to focus your energy on the options that are in play. Yeah,
that sounds good. And if I just wanted a flat out refinance, how old would my existing loan need to be, do you think, before it's worthwhile coming in for a chat?
I would probably say to check every 2-3 years. There's a caveat to that, I guess. One, it depends on what your loan structure looks like. So if you're on a fixed rate product and you're 2 years into a 5-year fixed rate, maybe the odds are that you'll probably stick with that fixed rate. The other thing is, are you in lender's mortgage insurance territory? So if you bought the property and you're sitting at 95%, even back 6 months or a little bit longer, you could up to like 97%, even 98%.
Wow,
so if there hasn't been much in the way of appreciation in value, or you haven't paid down the loan substantially, you might be up for lender's mortgage insurance with a new lender, and that may negate how much you save. Benefits. So you might still be on a higher rate in terms of interest costs when compared to what the market offering is. But if you were to switch, your barrier to switch would be the refinancing cost, because there is, or in any refinance, there's usually give or take like 1,000, 1,500 in costs, just for discharging the mortgage, registration of the new mortgage, the discharge fee that the lender pays if you're generally on a variable rate. So there are costs involved, but it just increases that cost. So breaking from a fixed rate is going to be another hurdle. Lender's mortgage insurance is going to be another hurdle. So, and sometimes it could make sense, or maybe you do want to move from a variable to a fixed to a variable, and the numbers stack for you to do it. It just depends on what the current offering is.
But if I'm on a variable loan and I've had my loan for 5 years, I've been paying it down, I'm a bit ahead, there's significant financial benefits for refinancing, isn't there? Because aren't some of the banks offering?
Yeah, they are.
Cash?
They are absolutely going for it in terms of the promotions and things like that. I guess. I generally don't think of promotions straight away because it will depend on. Usually, these instances are triggered by a need to do something, so sell or refinance, get the equity out and purchase, or things like that. But there definitely are. I guess price for me is always integrated into product selection, but it'd be the first one would be like loan approval. I guess it's like, are you gonna get the loan? Purpose, then loan approval, and then followed by these are your options, and then the natural selection would be who's offering, who has competitive interest rates, who's offering promotions, which one would be the easiest to move, like a whole bunch of things. Speed might sometimes be a factor as well. Some of the lenders, I won't name them, are still struggling with the speed of application. So if you're wanting to move quickly, that could be also a factor in the thing. So,
okay. Alrighty, now I know we are short for time, but can we just have a look at the graph that we were talking about before? Sure. So in the current market that's changing so quickly, whenever I'm speaking to anyone, we always do a little bit of a market check. And I would have to say at the moment we really are, it really does feel like the bottom of the market was last week.
I've been talking to people, to buyers all the way through, and of course we had this really big peak of people starting to buy at the end of June, early July, and a lot of people then just hit the brakes when Melbourne went into deeper lockdown.
Right.
But you'd have to say it's really looking like and feeling like it's all starting to happen again.
Yep.
So are you seeing the same sorts of indicators?
Yeah, so clients who were in the market looking are a little bit more active now. There have been a few more inquiries about, mainly first home buyers coming into the market wanting to make full use of the grants available. And open homes as well on Saturdays, they seem to be relatively stable in terms of the numbers coming through. It doesn't seem like there's a lot of people avoiding open homes. I can't say that there's a whole bunch of people, but there were a couple of auctions last week, and the turnout was it was encouraging. Put it this way.
And so the graph that we're looking at now, so that shows at the middle of that graph is 100%. So that's the price as at the 1st of January 2020. And so you can see prices jumped up at the start of the year. That's not unusual. And then when we get to March, April, you can see things start to take a bit of a dive. And good old Melbourne, you can see they're really they've got a bit of a dip, but it's not that much. So
comparatively 98% somewhere, or 99 according to this index.
No, so Melbourne's the orange one.
98, yeah.
Yeah, right. So that's like a dip by 2%. This is data collated by CoreLogic, so one of the most reliable data sets. What we're seeing is, so Perth has already had a little bit of a jump. It's going to, bump along for a little while, but it really is starting to harden in Perth. Some great opportunities there. So with there's talk of some people really feeling like they'll be forced to sell once the bank stops the repayment. But the banks are also offering people another 4 months if they can justify it. So what we are expecting to see is that any impact from people feeling like they need to sell will be mitigated by demand. So I guess that's about it. And I noticed the time.
That's all right.
To get going. So thanks very much for joining us. If you've got any questions, you can definitely approach Ken directly from his company, and you can reach him at avvora.com.au or me at thepropertyfrontline.com.au. Thanks a lot. Bye.
Thanks. Bye.